We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Financial Partners. We are going to run the gauntlet today, and we're going to start to talk about tax planning. But tax planning from a financial planning perspective, it's a funny one because we're not accountants, and not being accountants, there's certain things in the tax world that we can't provide advice on. But likewise, accountants are not financial advisors, and the importance of working in conjunction with financial planners for clients is probably the key message out of today's discussion.
Yeah, I think historically it's probably not been well communicated to people that aren't in the industry who does what and who is specialised in which area. And also people in the past from both sides probably didn't really stay in their lane on it too well. So yeah, I suppose the key is we're meant to be a team working together, not conflicting each other or trying to talk the other one down. I think there's been a bit of bashing from both sides in the past. Clients get the best outcome when everyone works together as a collective. So I think we work hand in hand, and I think it's getting better and better.
Yeah, for sure. And I don't think we'll try not to spend any time at all other than this in this small comment about the fact that the regulator has put in place some pretty clear guidelines around what accountants can provide advice on and what financial planners can provide advice on. The important thing is that you actually go and speak to someone first. So don't consider what we're talking about here as advice. This is a discussion from our perspective about the types of sort of opportunities there that exist for accountants and financial planners to work together to get the best possible outcome for clients, and how we see clients actually present to us with sort of tax-related queries. I had a couple of notes here, Ben, about the fact that I was thinking that when we start to look at people's cash flow, inevitably one of the biggest expenses that people have if they do their cash flow or their budget well is their mortgage, but also tax. Like if they include tax as an expense as a part of their total income that they generate for their household, it tends to be up there in the top sort of 2 or 3 at least.
It's their number one pain in their backside as well. They hate it. Like no one likes paying tax. Obviously, it's a bit of an evil necessity, but you probably just want to pay as little as you have to. That's probably the key. And I think that's
without avoiding
it, minimisation, not avoidance. So I suppose that's what we have. I don't know how many meetings I would have had since I've become a planner. The first thing they come in and go, "Why did you come here? Paying too much tax."
Yeah.
Okay. All right. Well, it's pretty common that people feel that way, whether they're paying 10 grand a year or 150 grand a year of tax. Most people feel like they're paying too much of it. So it's all good and well. Again, without jumping too far ahead of him, maybe there's ways to minimise it, but are they actually effective ways of doing it? Like, you can go and spend money for the sake of it. And I think that's the old sort of farmer mentality, is build a fence rather than pay $1,000 worth of tax. And they build a fence they don't even need, but that feels better than paying for some tax. So it's a balance we've got to strike up and get right. At the end of the day, you're paying tax, probably generating income, which is probably actually a good thing. So yeah,
I think you've already mentioned this, but the question inevitably comes up: how do we give the tax man less, and how do we make the most tax effective use of the income and the assets that we have? And I lost it now. I did have the marginal tax rates off the ATO, but as an example, like if you're earning greater than $180,000, or if you're earning $180,000 a year, excluding Medicare levy, your tax before deductions is nearly $52,000 a year. So $52,000 of the income that you generate goes to the tax man, and then 45% plus Medicare levy above that 180,000, you're losing again to the tax man. Again, before deductions, before any tax planning, any strategies. And most people are a little bit, like you said, they're a little bit bemused that this is my biggest expense. What the hell can I do to impact it positively to my end?
Yeah, well, you go to the bank, you can get a better interest rate on your loan. You can cut down on going out for dinner 3 times a week. You can not finance your car. You can downsize your vehicle or your home. You can do so many things with everything else, but tax is one where there's things you can do, but it's tricky. Like they're the ones that you can't generally do yourself in the most effective manner.
I'd made a note here about the sort of the planning opportunities that we commonly see, and I thought maybe I could just sort of touch on each of those and then we can sort of discuss them. And you sort of talked about this right at the outset, that probably the biggest opportunity that exists for individuals to make better use of their income and pay less tax is to make sure that your accountant and your financial advisor have a good relationship, make sure they communicate regularly, and make sure that they're on the same page with the goals and the strategies that you have in place.
It's pretty simple in some regards, the relationship part of it. You need someone in your corner or multiple people in your corner to help you with this stuff. And most people say they're, a tradie, they're great at going out building a home for someone, but they're not expected to be an expert in minimising their tax. Like, it's just, you wouldn't expect that from them.
No.
And if they use their resources well, will pay someone to help them with that.
And the thing I like about having multiple people in your corner that have like some degree of crossover in the relationship, like sometimes maybe it can be seen as a double up, having a financial advisor, an accountant, a mortgage broker, a solicitor. Yes, there's some overlap in the functions and the advice that they provide, but I see that as a hugely beneficial thing. And importantly, I love it when we don't agree. So when we're having a discussion, as long as we've got a good relationship with an accountant or a client's accountant, that if there's some degree of disagreement about the outcome that we're likely to achieve, that promotes discussion. I think if there's good discussion, ultimately it leads to getting better outcomes for clients. And, again, we'll say it multiple times during these podcasts, and I think we've said it in previous, that it's so important that people seek professional advice around the areas of their life that they're not good at, and engage the right people and make sure that those people are talking to each other.
Yeah, I think the key is that those people talk to each other and, as a collective. This morning, even the simple little one of client, I say simple, but there's some complexity to it, is, client sells an investment property, need to get the accountant to help work out where they sit from a tax perspective. Then we're looking on our side of, okay, what strategies around contributions to super, etc. have we got that we can then pair with that to get them the best outcome. A couple of emails back and forth, they ask questions of me, I ask questions of them. Client sort of sits on the side just watching, seeing how it all plays out, and they get a really, really good outcome out of it. So the accountant on their own probably would have had their hands tied in regard to the super side of it. I don't have the ability to necessarily calculate and actually advise on the capital gain side of things. So, that's probably the really vanilla sort of one. But there's so many little things that go in it.
I was going to say it's vanilla because see it every day.
As I was saying, I was thinking, there's probably a bit more to it than you think. So
yeah. And that probably is coming down to some of the strategies that we sort of noted, or some of the common opportunities that we've seen. I suppose one of the first ones, which, again, you said before, staying in our lane, one that we're very good at encouraging people to follow up with their accountant on is making sure that you are asking questions. And we like people taking personal responsibility, but take personal responsibility to make sure that you're talking to your accountant about your specific circumstances related to any of the deductions that you might be eligible for in your work-related expenses, home office, travel, whatever it may be. Talk to your accountant about it. Most people don't. They just take for granted that the accountant will include all the relevant inclusions. So again, ask the question. Yeah,
and I think in the past I've had clients, I say, I'll flick through a copy of your tax return, and just another set of eyes. We just read over it and making sure, one, we understand exactly what they've been telling us is actually what it is recorded from an ATO perspective, but just another set of eyes to ask questions. A lot of the time you ask questions, the accountant explains it, and then everyone's in a better spot to understand why it is that way. So everyone feels like they have to do a tax return anyway, so they sort of fall into that system. So they send their docs in, they get a refund, or they pay a small little bit to the ATO maybe. They just roll on to the next year. They don't really harshly review it themselves or even necessarily fully understand why, how it is that way. So again, sometimes I just like to read through it as well. It gives you another insight into what's going on in their finances. Yeah, agreed. That brings us probably to the next one. It's got to be one of the most common in financial planning land in terms of the types of sort of, what do they call it, tax financial advice that sits in our brief that we can advise on where there's tax implications. Super contributions is a huge one. And that example we had earlier on where I said that someone earning greater than $180,000 a year pays somewhere in excess of sort of $51,000 a year in tax. Super, either via salary sacrifice, via a sort of lump sum contributions, and potentially even catch-up contributions using previous years, concessional contributions, is a huge one. Now, I've probably said three things there that those uninitiated, it's just gone straight over the top of their head.
But super contributions as a method for individuals to help reduce the amount of tax they pay is a massive opportunity.
Yeah, I think it's becoming more and more looked at. Like, people are actually embracing super more and more. Like, it's just, now that it's been around for decades, people are seeing the benefit of their parents retiring with a, nice amount of super there that can provide them a lifestyle. So people are a little bit more open to it. And there's a nice kicker that you save some tax. So you get the double win out of it. Again, you want to make sure you make the right contribution. So I've seen a lot of people where they're making contributions, but are they the most effective ones? So, is that from an investment point of view in terms of they're making just one big one a year, which, it gives them the same tax outcome, but maybe it's not as effective at smoothing their market risk as well. Or maybe they're using salary sacrifice when they should be using personal deductible contributions, et cetera, et cetera. You've got contributions, you've got so many different types of them. We need to make sure we're making the most effective ones, claiming the most effective ones at the right times. So every year is going to be different as well. So that's where we probably harp on a lot about our review process and continuing to question it, look at it, and change it. Like, it's not just a set and forget as well.
Yeah, and there's certainly examples, and you've had many of them, where a client comes in with that initial discussion of saying, what can I do to minimise the amount of tax that I'm paying? It's one of my biggest expenses. They're in, top marginal tax rate territory, and you look at what they've done with the use of super, and it's nothing. And there might be very good reasons for that, and those reasons, I think, will probably flow on into some of the next discussions we have. Like, it tends to be about how people prioritise their income, and you've got to kind of overlay multiple things. You've got to overlay sort of your own personal and lifestyle priorities.
The here and now sort of stuff.
Yeah, together with your tax priorities, together with investment priorities. And it's this layer cake of sort of aligning, trying to get the right balance of all of those priorities, which is, I suppose, where we come into the forefront of people's mind, because we have the ability to sort of bring those multiple priorities together and then put them in some sort of reasonable order that gives people the best outcome.
And the people probably think, they're banging on about put money into super. For a lot of clients, it might be we just do a very, very small contribution, but we know we can maintain that for a very long period of time, or we know if we get a few other things working, in their here and now situation, their cash flow will improve. They'll be able to put more in later, and they can then continue to build wealth. So, super contributions, I think probably financial planning in general gets a bad rap in terms of super planners. Yeah, it's one piece of it. And if we can get everything else working even better, then you'll be able to afford to put more into super without compromising your lifestyle or compromising your non-super investments or your debt reduction strategy or all those other things. So, again, sometimes we just got to walk before we run with that stuff and just really start ticking it over a little bit. And then, again, the review process is to keep twisting and making it better and better.
And, I mean, there is a reason why there's been a heavy focus to superannuation for advisors for a number of years. And that's because the outcomes are pretty good. They're certainly good from a tax perspective. And these are the things that, I suppose, again, we're seeing every day, and we take for granted the fact that we understand that making a contribution to super helps people with their tax position, but also it's building this pool of funds that at some point in the future, if managed right, will be a nice tax-free lump sum that generates a tax-free income for that person in retirement. So there's a fairly heavy motivation for the client to make the most effective use of their income for their super, which is why we talk about it a fair bit. Probably feels ad nauseum, but it's an important piece of the puzzle.
Yeah, and I suppose when you see and hear from our clients, and we hear it ourselves, and you see it through their testimonials and their word of mouth referrals, that the ones that have been doing it for a long period of time get it. And I don't think anyone walks in on day one, first meeting with a planner or even an accountant, and thinks, this will work out, can see it immediately. You're going to have some hesitation to it, and you've just sort of got to live it and experience it and stick with it. And then you start to realize how it all comes together. And you see that next phase where, I think entering that retirement phase, whether it's transitioning to retirement or into full retirement, how effective it is that you're not paying any tax on the money as it comes back out again. So for some people, it's adding an extra 30% realistically onto what they are generating. So they might have had to work and earn 75 grand a year, but they only need to draw 60 from super because there's just no tax on it anymore. So it's pretty significant coming back out the other way.
All right. So the next item I had noted here in terms of common sort of planning opportunities that we see, and again, these are not strategies in their own right. They're just areas of advice that we see, and that's around gearing. So one of the other areas that we generally are providing advice on is gearing and borrowing for investment purposes. I think the flow on for that when we start to talk about advice, I think we can comfortably say that interest on debt that's used for investment purposes is able to be claimed as a tax deduction. You can speak to your accountant about that, but it's pretty widely known. I don't think we're saying anything too controversial when we say that. But there is like multiple instances that we see where people have maybe structured their debt incorrectly, or they haven't had the foresight to think about what's going to happen over the course of the coming years about how they should structure their debt if it's going to be for investment lending. Yeah, I'm sure you've got a few examples.
Oh, yeah. You could sit here all day and go through. I think probably one of the things with that is, and again, it comes back to that team part of it, is if someone walks into a bank off the street and says, I need $800,000 to buy a property, the bank isn't necessarily thinking about it from a tax outcome perspective. They're just thinking, they need $800,000. How can I get it to them?
And they're probably not also thinking about it from a financial planning perspective either.
No, they don't really care too much. They've got, and they're not got a narrow brief. You come in, you ask for something, and they find a way to provide it to you. So, working with brokers who deal with investments a lot and working with, even the accountants and understanding the structure behind it can make that outcome so much better and actually fits together. And again, like you said before, the one that always comes to mind is so many clients buy their first home and think this is not forever. This ideally becomes an investment property. How do I go about structuring that to make sure I don't compromise advantages in the future? So again, we won't go through all the strategy around it, but it's hard to unwind it. Like if someone lives in that, they were living there for 5 years and they end up whacking a heap of money off the loan versus sitting in an offset account, you've got to start to look at the pros and cons. So there's lots of little bits, and people probably think, it doesn't make a difference either way. The bank goes, you can use an offset or you can have a redraw account. It doesn't. The bank will say, it doesn't make any difference. If you need the money back, you can pull it back anyway. Yeah, that's accurate on the here and now basis, but the long-term impacts from a tax perspective are significant if it does become investment. So again, all of those little bits, and it's not to scare people, but just ask and talk to people about it to get it right.
Because that would be that scenario of people saying, listen, I want to minimise my tax. Maybe supers the conversation, but one of the other very common ones is, should I be investing? Should I be borrowing some money to invest? And if the structure's not right, we set ourselves up for failure. Like even just in the rate that you can negotiate on any investment debt, whether it be for a property or whether someone's thinking about doing some margin lending. I'm not sure whether we've talked about that on a previous podcast, but I'm sure it'll come up. But there's certainly opportunity for people that have, good cash flow, are in a sort of a high marginal tax rate position, maybe have cash, maybe have equity in their home, to utilize investment borrowing to help them manage their tax position. But it needs to be structured right. And you really needs to have those two professionals, the accountant and the financial planner, working very closely to make sure you do it right.
100%. It's complex. Like there's no sort of two ways about that. It's just it's a complex area. So if you want the best outcomes, generally speaking, there's going to be some complexity to it. So you just got to make sure you get the complexity in the right areas and manage that complexity with people who understand it. And for them, it isn't as complex because they deal with it on a daily basis. Like if you told me to go and build a deck out the back of my house, I'd say that's pretty bloody complex and I've got no idea how to do it. But for a builder who does it every day of the week, he just walks in and just does it, like doesn't even think twice about it. So it's get the right people in the right spots.
Yeah, and you mentioned something about the foresight of thinking, what's this property going to look like in 4 or 5 years? The next point I had here around common planning opportunities around tax is the type of investment you own. So again, without going too deep into this, what type of investment are we wanting to own? Like who's going to own it? That has a huge impact on the tax implications depending upon your current tax position or your current income position. Am I looking for income or am I looking for capital growth? So if I'm investing for something and I don't want to create additional income tax issues in the short term, maybe I'm more focused on an investment that's going to give me longer term capital growth. But then if I've got capital growth from an investment, a property, shares, how do I manage the sale of that asset? So you add all of those elements together. And, a lot of the discussions we have with clients are, I'm going to buy an investment property. Why? Because
property goes up.
Yeah, property goes up. the conversations about, okay, who's going to own it? Whose names are going to be in? Do you need the income? What are you looking for? What's the purpose of this property? Is it for retirement? Is it for, I don't know, lifestyle purposes at some point down the track? And how do we think we might forecast managing the sale of that asset in the future?
Yeah, I think, again, I always love when people are motivated to invest, whether that be property or otherwise, but then you want to make sure they get the right investment for what they want and what they need out of it. So again, property is always the common one because it's tangible and people have had experience because they've most likely owned a home themselves, but it fits really well for some people. Others, it depends on what style of property even that fits in there. And then you've got obviously shares, managed funds, term deposits, bonds, everything else that fits in the rest of the world. I think sometimes we overcomplicate that too. Like I think sometimes we go, okay, we're going to, buy an investment property, and then for some reason they get in their mind, we'll do it through a trust. We'll set a family trust up or a discretionary trust, something there to hold it. You also don't want to overcomplicate that. I think that one thing I've seen, and I think accountants are getting much better at this, is not putting entities in place for the sake of having entities in place. Like a lot of the time the outcome would have been the exact same if it was owned in the husband's name, the wife's name, joint name, whatever it may have been. In the past, it was open a trust, whack some investments in there. Oh, yep, that's good. It's in the trust. All the earnings were still trickling down to the same people at the end of the day. So as much as we want to use complexity where it's required, keeping it as simple as possible for the outcomes that you need is probably where I think we're pretty good at carving that down and doing it as simply as we can to get the outcome required. Yeah,
definitely. And I think that was when you talked about trusts. I think that was the last point on mine, is that, listen, it does play a part. Like as people's, particularly with small business owners, as an individual who's been a sole trader for some time starts to grow their business and their revenue, there is sort of an inevitable movement into more tax effective structures. But it's got to be horses for courses. Like you said, it's not just a one size fits all. Someone's buying a property, put it in a trust. Like the outcome needs to be thought about. And again, I've said it 4 or 5 times now. That's where marrying up someone's actual financial objectives and lifestyle objectives with the tax objective is so critical. You've got to marry the two together. Otherwise, you end up with something that's only designed to provide a tax outcome that doesn't help them with their lifestyle, or vice versa.
Yeah, you can think of examples all the time. I had clients where they came in, they're thinking of doing a very small investment account for their daughter. Someone had said, potentially you should look at doing it through a trust so you can, protect, from an income distribution perspective. When you looked at it, that, the husband had a large income and the wife had little to no income. So potentially they were going to look at spending an extra $1,000 a year on a tax return for an entity to save no tax, because there was no tax potentially if the investment was held through the wife's name, as a hypothetical, not advice. So again, you look at it and you go, well, is this the cost benefit on everything, really? That's what it comes back to. You go, well, it's not worth the complexity for that. And, in the future, if things change, okay, we can, review that and alter it. But it's not just plug in a trust and get a better outcome. I think there's a bit of a perception that, people using trusts are, hiding from the tax man. Well, everything has to exit the trust, income-wise.
Good luck hiding from the tax man these days.
Yeah, it's impossible. So you're better off just being openly honest and just being all above board and just having a plan than trying to fudge it and hide things.
Yeah, that's why tax avoidance is illegal. Minimisation is a welcome strategy. Everyone wants to make sure that they make the most effective use of their income. Yeah. So the last handful that we had of areas that we generally see, salary packaging's one. Again, it's not for everyone, salary packaging. I think the thing that I've noticed, particularly for people in not-for-profit organisations or in the healthcare sector, they have a very unique opportunity to take advantage of salary packaging. And salary packaging, in short, is the ability to pay some expenses that would normally you wouldn't be able to pay before tax, have them taken out of your salary beforehand. And so I suppose the main point there is that if you're in any of those industries, not-for-profit or healthcare, and you haven't thought about or haven't asked payroll about salary packaging arrangements, it's a pretty good one it's a quick and easy one to have a discussion about.
Yeah, I always say anyone with the ability to do the packaging, nurses and stuff are probably the most common clients we have with it. And so this is one of the biggest gifts you can get from a tax perspective. So make sure you speak to the provider, who's usually they're linked to your employer now. Talk to them about it. Make sure it's all as it appears, and try and make use of it. It's a bit of a grey. This is probably one of the areas I find them personally the hardest to deal with in terms of the crossover of what we can and can't do. And I think it's where I've found relationships with accountants have been the best benefit to me, because you can quickly have a conversation with them. They probably ask you from a cash flow perspective and overall strategy perspective. You get their tax overview on it, and the client gets the best outcome.
Yeah. The net extension of that, and I'm the same way. Like, there is a crossover there where we run, and we're very cautious running the gauntlet with giving advice. Salary packaging of motor vehicles is one that comes up all the time. Like, people say, listen, I want to buy a new car. Can I package it? And there's a multitude of different organisations that have popped up over the course of the last few years offering packaging arrangements for motor vehicles, leasing a car and saying that there's some tax advantages, potentially paying some of it before tax. Can be complicated, and the most important thing with that, as we've said, is that you've got to speak to your accountant. But also, I had one just recently, so in the last week or so, and they are in sort of the healthcare sector, and they didn't really know a lot about what they could or couldn't do, but they knew that there was a salary packaging provider that Burke offered. And I said to them, and they were looking at buying a new vehicle, I said, the most important thing you do once you've made a decision about the type of vehicle, first of all, that you need one, and the type of vehicle that you want, is to go to that salary packaging provider and get them to give you a salary package versus non-salary package comparison of their situation. So they can make an informed choice and actually see there whether they're actually going to be better off or not.
When I look at it, I try and almost take a step back from that. Get that comparison always, that's the starting point, but then looking at it holistically and going, you've got cash sitting doing nothing. Yeah, it doesn't necessarily feel good to go and bury 30, 40, 50,000 into a vehicle, but what's the purpose of that cash? Does keeping your cash flow clean from another loan repayment actually help you more with something else? Again, it depends. This is the biggest depends one I think I probably come across, which is why there's some science and method to it, but it's also very much person to person, family to family.
That's a pretty good point. And I should have said that the first conversation with that client was, first of all, do you really need a car or do you want a car? So the first conversation is, they want a car. All right, is it a want or a need? If it's a need, and in this instance it was a need, next question is, what's the funding mechanism for that? Like you said, I can use cash, I could use
loan redraw.
I could just go and get consumer finance, or I could get finance and potentially talk to a salary packaging provider about how I could package that. It's important to compare all of them and have the discussion about which of them is going to be most suitable for me.
It gets really complicated because you might be looking at, again, redrawing on your home at 2% versus the loan provider giving to you at 6.5%. And then, sometimes the difficult part with the packaging is that there's a rate. You're not getting it for free. There's a rate built in there, so you've got to try and dig down and work out what that actually is. So again, it's not.
And it's also there's a real psychological incentive that if you're seen to be able to get something that helps you with your tax, you can spend more.
100%.
Therefore, I can get a more expensive vehicle because I can salary package it and get greater tax benefit, but you've actually got to have the expense first.
There's also, I think the tax part is just one of those things that we tell it. If we want to convince ourselves of something, we're pretty good at it. Like if you want to go, I need those new shoes, I'll wear them to work, I'll be able to wear, easy, done, we'll get it. So sometimes with the car thing, I see it is the people who run the packaging, selling these cars are pretty smart. At the end of the day, they're mostly salespeople. They're not finance professionals. They want to get you signed up.
Are you saying we're not salespeople, Ben? Is that what you're saying?
Not